It's Tuesday and you're watching FreightWaves Now. I'm your host Anthony Smith, and coming up, Luke Floska is going to give us a broker update. We also have Andrew Cox back with us with a shipper update, but first we're going to go to Zach Strickland with carrier update brought to you by PowerFleet. Stay tuned.
Hey everyone, and welcome to your Tuesday carrier update presented by PowerFleet. I'm Zach Strickland. So, looking at the outbound tender rejection index, we're noticing that we are accelerating into the holiday. This is something that we anticipated, of course, but we didn't know just how fast that this rise would happen. So 9.39% tender rejection rate. If you look at this trend line that I've drawn here, over the past 8 days or so just over a week, we've grown 3.07 percentage points. So it was around 6%. Just over a week ago, and now we've risen pretty quickly to over 9%. So this is indicative of a lot more spot market activity out in the United States right now. Again, we've been talking about some of these markets being isolated. A lot of West Coast tightness is kind of translating into the central U.S. currently, but again, this is a pretty good tender rejection rate. Again, seasonally expected this time of year as we approach July the 4th. So again, the rate of rejection is really significant here, and that is very indicative of spot market activity and spot market growth. Everybody out there needs to be aware of that, especially if you're entering a market that you need a backhaul at this point. So tender volumes, outbound tender volume index, volumes are rising as you would expect this time of year. A lot of shippers trying to get their freight off the dock before the holiday. Potentially, some of this obviously is seasonal, some of this is, COVID recovery related, etc. But this purple line that I have on top of it here is the outbound tender lead time index. So you can see, in combination with the volumes increasing, we're starting to see those lead times increase. Now, the lead time is the difference between tendered date and requested pickup date. So the longer that a carrier has to, make adjustments to the network, make sure that it has, a truck out there ready to pick up freight, the better they are. That tends to lower the spot market rate or the rate that they're getting. It also allows a lot better management of the network in general, like I said. So tender lead times are increasing. Shippers probably anticipating a pretty tight next week, specifically going into the holiday. So they're getting those lead times up a little bit, as well as pushing a lot of this freight volume. A lot of this volume could be picking up this time next week. So carriers certainly need to make sure that next week, especially, if they're bigger shippers, or, whatever they need to do to make sure that they're in position next week to make it happen, they probably should get there. But also anticipate probably some of the tightest conditions that we've seen since, of course, the big outbreak back in March, where everybody is panic buying. Something also interesting to point out here is the fact that lead times really expanded in the middle of April, very divergent from what we typically see. You can see that they tend to move together for the most part, especially as you enter holidays, as we're doing right now. But back here in April, we saw these lead times expand dramatically as shippers just really didn't have as much emphasis on getting this freight off the dock. So fascinating little tidbit there to point out. But again, we do appear to be moving back into what a normal pattern is, and that's the significance here, is that we're looking more like a regular type of freight market activity versus that real divergent pattern that we saw back in April. Looking at the tender rejection volatility, listed from top to bottom, we've got the strongest increases, statistically speaking, in Tulsa, Oklahoma. Like we mentioned before, a lot of the tender rejection activity, the tightness there, is coming from the central part of the United States. If you look in these lighter shaded green areas, you can tell that a lot of this is really traveling up the Mississippi right now. A lot of increases there. Dallas, we've talked about. Jackson, Mississippi, as you heard Luke talk about, as well as some of this West Coast stuff. But again, a lot more green showing up on the map this week, as tender rejection rates really starting to pick up. So these areas right here, really pay attention to. If you are entering any of these markets, you might have a little bit higher chance of getting some freight on the spot market. Now, the head haul index, this is the head haul volatility. Where are we seeing volumes increasing disproportionate to the inbound volumes? Where am I going to have a lot of contracted freight coming out of markets that might be changing the conditions in those markets? I wanted to point out, again, central area right around Memphis, the central part of the country, again, increasing outbound volumes in relation to inbound volumes. Savannah, Georgia over here, I want to highlight that one real quick because that's one of the most significant markets in the United States for imports coming into the country. A lot of mid-haul freight coming out of Savannah right now and tweener freight. So anything moving from about 450 miles to 800 miles really taking off right now. That's going to be anything outside of this little circle here going from like Nashville over here to Jackson. So again, pay attention to Savannah. Rejection rates starting to really heat up as we enter the holiday. That'll do it for today's Carrier Update.
The comprehensive logistics offerings from PowerFleet cover in-cab ELD, fleet management, trailer tracking, cargo monitoring, and tracking other assets such as chassis and intermodal containers. Power up your operations with PowerFleet.
Good morning, this is Luke bringing you another broker update. As we continue to look at the freight markets, particularly volume and rejections, they push to almost new highs. Obviously, they're still a bit off from that panic buying surge in March. When we take that out of the equation, a lot of markets are already at their all-time highs in terms of volumes as well as rejections. Let's take a look. First off, of course, just to keep an overall view here in the freight market, in blue, you've got the overall volume levels continuing to push higher, right? We thought we were going to slip into the seasonal pattern here, remain relatively flat after this June pop right after Memorial Day, but that's not the case. We're continuing to push higher. And rejections, that orange line there, you can see we're sitting at 9.39%. That is very, very high, almost double where we were this time last year. As that continues to push higher, capacity is going to tighten, spot market rates will go up, and shippers will have a harder and harder time covering their freight at their contracted rates. So as that goes up, you should have an easier time covering loads, but also keep in mind spot market rates will rise as carriers will ask for that premium. Let's go right ahead and jump into our map here. We're going to look at the weekly tender rejection change. We looked at this yesterday, and today you can see there's a lot more blue, but also dark blue. The areas in white are an increase in weekly tender rejections, but the areas in blue are an extreme increase in tender rejections, usually over 5%. So when this happens, look at Texas. Texas yesterday was only along that border area there, the Mexico border was blue. Now almost all of Texas is blue, especially those major markets like Houston. Down there, you've got Dallas, you've got Austin, Fort Worth. Very dark blue is down there at the border around Laredo, San Antonio, some of those other areas. Western Texas, where there's not much going on, still a little bit red, so that's decreasing. But out where everybody lives in Texas is still very, very blue. And then, of course, look here, Mississippi, Arkansas, a little bit of Tennessee, Missouri, very dark blue. Tender rejections having substantial increases here over the last week. If you're moving freight in those areas, you're going to really need to increase spot market rates. Carriers will ask for that premium. But also, if you're not moving freight, call shippers in these areas. They're going to have a harder time covering their freight. Their routing guides are falling apart as those rejections continue to increase. Great opportunity. If you have capacity, call on shippers in these areas. You should be able to call in, be the hero, and win some freight today. Let's go ahead and look. Right now, what we're going to do, we're going to look at something a little bit differently today. We're going to look at the top 10 largest markets in the United States by market share and see where they are on their 52-week trending basis, low versus high for the rejection. So if you look all the way over here, notice we've got the top 10 largest markets. So you're looking at Atlanta, Ontario, LA, Harrisburg, so on, going all the way down. What these gauges represent is the far number on the left is the 52-week low. The number all the way on the far right is the 52-week high. Most of those 52-week highs were set in late March when that panic buying surge happened when COVID really hit the U.S. And most of those lows were set shortly after that in mid-April when we fell off of that panic buying surge. So you can see here a lot of these that are starting to trend very close to their 52-week highs. They're moving a lot higher here, especially Ontario. You've got LA, Dallas, looks like Houston's also pushing much higher. That's tightening up capacity. These large markets right here are really driving that tender rejection growth in the United States. So keep an eye on those. And look at this, Ontario right here, massive surge right there at the beginning of May. We were under 2% and now we're at 12%. And then to do the same thing here for volume, same thing, this is just for volume. Harrisburg, Pennsylvania is the closest to their 52-week high. In fact, they're at their highest volume levels year to date right now. So keep in mind that's really going to tighten up capacity. That will do it for today's broker update.
Welcome to your shipper update. I'm here with Andrew Cox. Andrew, what do you have for us today?
Today I got a little bit of a housing market update. We had a lot of big data sets come out last week and the week before, so I think it's time to touch on them a little bit. So this is our new home. This is new building starts, new home starts. It jumped 4.3% in May off of the 5-year low in April. We're now at an annualized rate of about 974,000 homes, new homes being built in the U.S. this year. That was slightly lower than expectations of economists that were expected, but it did jump significantly off of April, and it does point to me that things will recover even more in the coming months. And I got a couple reasons for that. One is we look at the permits, which kind of give us, a forward-looking 3 to 6 month outlook on new home starts. That jumped incredibly, jumped almost 15% off that low again in April. So that gives me a lot of confidence. And there's some other things that give me confidence as well. One is the mortgage applications. So the Mortgage Bankers Association, they put out some data in May and all the way up to mid-June about mortgage applications. They said they had risen 9 weeks in a row to an 11-year high mid-June, and actually was up 21% year over year mid-June. So I think that's really positive. Plus the new home builders sentiment index, which we'll get to here in a second.
Excellent. And one of the things when we're looking at housing starts, especially new home sales, it's a smaller portion compared to existing home sales. But the thing is, inventory has remained tight now, whether that be through demand over the last couple of months or just through limitations on building products and supply chain disruptions.
Yep.
This has really significantly impacted the inventory and really kind of kept prices up despite all the pandemic woes that's been happening.
Yeah, you're right. So they usually look at like a 6-month stock of homes up for sale. That would be kind of a balanced market. Right now we're looking at about 4.5 months of stock. So you're right, that stock is lower. That has kept prices high. I believe the average price was up in the low single digits, up to about 284,000. So that was a positive sign. One of the little bit of a negatives that I saw at least was the fastest growing market here in the Southeast had starts drop a little bit, but we did see the Northeast and the West Coast. That's kind of where the big surges in housing starts were. But that thing that I was mentioning to you a little bit earlier was that home builder sentiment index. This is something that Wells Fargo and the National Home Builders Association puts together. And if we're ever looking for that V-shaped recovery in something, this is probably the best example of it that we've had so far. And a lot of our economic data, this has only taken 2 months, and we're back up again. We're here where we were in 2017, but things are very positive. These home builders are seeing the same thing that we've spoken about, which is the mortgage applications and the hopes that they can continue to keep building throughout the end of the year. Mortgage rates are extremely low right now. There's a high demand of people your and I's age that are looking for their first home. So I think it's a good time for home builders. This is one industry that I look to that has actually survived this pandemic pretty well.
Right, and this was in very good standings before the pandemic, right? So there was actually supply side issues. There was a high demand for homes, new homes, existing homes, and that was really, really drawing a shortage on inventory before the pandemic.
Yeah.
There were a lot of folks that wanted to buy homes, specifically, as you mentioned, entry-level homes, first-time home buyers. They were not able to. So it's looking like, just as you mentioned, this is rebounding quite quickly, and I think a lot of analysts and economists that are active in this field are expecting a very active summer season.
Yeah, they're thinking that even by the end of the year that we could see year-over-year total gains for 2019 over 2018. As you said, there were some major issues there in 2018, 2019, whether they're all supply side. They were looking for labor. Lots were a difficult issue as well, looking for new lots, and also lumber. The trade war with Canada was kind of putting a pressure on lumber. But some of those issues have subsided. The new NAFTA being put into place, that should help trade between lumber, would help that. But again, that labor issue may not be so much of an issue as well. We're seeing unemployment at 13-14% right now. There is able-bodied workers out there. So some of those issues are they're getting over it here in the housing industry, and now we're just going to be stuck on demand. We're going to make sure that there's enough demand here. I know that government money is running out soon. That's helping keep up the entire economy right now. There will be things to watch, but I have a good eye and good hopes for the housing industry for the rest of the year.
Thank you so much, Andrew. Insightful as always, and thank you so much for tuning in. That's going to do for this edition of FreightWaves Now, but the content does not stop here. We're always streaming around the clock, so check out our FreightWaves TV app on all your favorite streaming platforms, including Apple TV. Thank you so much for tuning in, and we'll see you on the next episode.